Hello everyone. Hello everyone. My name is Raghav Bajaj. I am a principal associate in the direct tax practice at Khaitan, and I am your master of ceremonies for today's webinar. I would like to extend a very warm welcome to our audience in India and around the world for this webinar entitled New Corporate Tax Rate Regime in India. Thank you for taking time to be with us today. In this webinar, we will explore the salient features and the caveats of the new regime, its implications for manufacturing and non-manufacturing companies and limited liability partnerships, and the changes to the mechanism for taxation of dividend distribution from 1st April 2020. This webinar is timely and topical because number one, post the corporate tax rate cut in India, India has become a highly attractive jurisdiction for foreign investors. Number two, with the supply chains getting disrupted due to the recent unfortunate coronavirus outbreak, MNCs are being forced to look for local manufacturing options. In fact, this may give a fillip to the government of India's Make in India initiative. And number three, with the changes to the mechanism for taxation of dividend income, repatriation of profits to shareholders will also become tax efficient. Certain housekeeping announcements. The format for today's webinar is in two parts, a presentation and then followed by a live Q&A session, which will provide you with an opportunity to raise issues of importance with our experts. To submit a question, please use the Q&A panel in the webinar portal. We will endeavor to answer as many questions as we can during the webinar. A copy of the presentation and a link to the video recording will also be shared with you after the webinar. Without further ado, I would like to introduce you to our speakers for today. Our speakers for today are Vinita and Ritu. Vinita is a director and Ritu is a partner in the direct tax practice at Khaitan. Both our speakers bring a rich and diverse experience of more than a decade in advising clients on corporate and international tax, tax treaties, transfer pricing, transactional tax, tax due diligence, and tax efficient structuring of inbound and outbound investments. Ladies and gentlemen, please welcome Vinita and Ritu. This slide shows what we have in store for us today. The new corporate tax rate regime has substantially reduced the effective tax burden for companies in India. It is expected that under the new regime, there will be an increased ease of doing business in the country, and it will encourage global companies to set up and expand their base in India. In this webinar, our experts will discuss the key features of this new regime, explain how it impacts existing companies, manufacturing companies, and new manufacturing companies who are planning to set up investments in India. We will also take a look at how the corporate tax rates are in major jurisdictions around the world to assess where does India stand when it comes to global tax rate wars. As I mentioned earlier, the presentation will be followed by a live Q&A session where our experts will respond to your questions. When it comes to Asia, there is no doubt that Singapore is a preferred jurisdiction given its 17% corporate tax rate coupled with a stable economic environment. At 25%, China is not the cheapest tax jurisdiction, but then it scores high on account of economies of scale. In developed jurisdictions like US, UK, corporate tax rates are around 20%, and this becomes a key factor for MNCs when they are planning investments in these locations. Jurisdictions like Australia, Netherlands, Spain, South Africa have retained their corporate tax rates in the range of 25% to 30% and still have managed to be business-friendly jurisdictions. To explain what the corporate tax rate regime is in India, Before and after the announcement of the new scheme, I would like to invite Ritu. Ritu.
Thank you, Raghav. So the Government of India introduced the new corporate tax regime in October 2019. And before the new regime was introduced, the corporate tax rates in India looked like these. For the manufacturing companies, they had an option to pay corporate tax rate at the rate of 25%, which after adding surcharge and cess resulted in an effective tax rate of 29%. These manufacturing companies were not allowed certain incentives and deductions, such as reduction on account of additional depreciation, etc., which are otherwise available to manufacturing entities. But here, since the tax rate was a lower tax rate compared to a general rate of 30%, some deductions were not allowed to these companies. The other bucket was this turnover linked threshold condition linked tax rate. So for companies which had turnover of less than 400 crore INR in financial year 18-19, that is last to last year, those companies were subject to tax at 25%, let's say in the year 2021. And after adding surcharge and cess, that results in an effective tax rate of again 29%. Now, if you compare these two regimes, there's not much difference in the tax rates because both regimes developed over a period of time. For example, the turnover criteria earlier used to be 250 crores. That has been now increased to 400 crores, which covers more companies than it used to be. For this 25% tax rate to apply, there is no other condition except the turnover criteria. And if companies are not falling under either of these buckets, then the general corporate tax rate was 30%, which after adding surcharge and cess resulted in an effective tax rate of 35%. Now, all these companies are subject to minimum alternate tax. What is minimum alternate tax? It's a tax which is applicable based on the accounting income of a company. And this tax rate or the tax levy was introduced years ago to basically ensure that if companies are not paying enough tax based on its taxable income, then those were required to pay a minimum tax based on accounting income. And a taxable income could be different from an accounting income, say on account of tax holidays, tax incentives, or let's say tax depreciation and depreciation under accounting norms. Now, MAT itself has triggered a lot of litigation in the Indian taxation jurisprudence, and whether accounting profits can be questioned by the tax officer, what should be the accounting adjustments. Taxpayers also looked at, structuring possibilities where the income is not taken or routed through the profit and loss account so that that income is not subject to minimum alternate tax. So this itself has triggered a lot of litigation, and these companies were subject to minimum alternate tax at the rate of 18.5% if the tax payable under normal provisions is less than MAT. Moving on and focusing more on the corporate tax regime which is now introduced, the concessional regime. So in October 29, government announced that the manufacturing companies, subject to certain conditions, could now opt for a rate which is as low as 15%. It's basically half of the otherwise applicable corporate tax rate. The surcharge for these companies is capped at 10% and cess 4%, which results in an effective tax rate of about 17%. These companies need to satisfy certain conditions, such as when they should be set up, when the manufacturing should commence, and these companies are not allowed certain incentives, such as additional depreciation. We'll delve deeper into these conditions in the course of the presentation. The other tax rate which has been announced is 22% tax rate. For availing this tax rate, company can be manufacturing, non-manufacturing, new, existing. There is no other condition. It's going to cover a broader range of companies. And here, after adding surcharge and cess, the maximum effective tax rate for such companies will be 25%. The other tax rates of 25% and 30%, which we discussed in the previous slide, those continue to apply. However, these rates have now been announced and these are optional. So companies can opt for these tax regimes after evaluating certain factors, which we'll take you through during the course of the presentation. The important point to note is that when these new corporate tax regime was announced, even the tax rate of MAT has also been reduced from 18.5% to 15%. And importantly, the companies falling under the 15% regime and the 22% regime, those are not subject to MAT. So this is quite a step taken by the Indian government, where they have substantially rationalized the corporate tax rates. They have removed MAT for these companies and even reduced MAT for other companies. Now, for these companies, whether MAT is an issue, because anyway, these companies are not allowed certain tax incentives and tax holidays, the answer would be a yes, because even for this 15% regime companies and 20%, 22% regime companies, there could still be a difference between accounting income and tax income based on factors such as, again, tax depreciation versus depreciation under accounting norms, or let's say where company is writing off a liability. So those companies which are under distress, when they write off liabilities, that impacts the accounting income, but that write-off may not necessarily be subject to tax under normal provisions. So those companies do not have to now worry about the MAT incidence, which was until now an issue of concern for those companies. Now, this is another important change which has been introduced in Budget 2020, and it is proposed to take effect from 1st of April 2020. This is with respect to taxation of dividends. So until now, under current law, dividends distributed by an Indian company are subject to distribution tax payable by the distributing company, and the tax rate is quite high. It's about 21%. For non-resident shareholders, there's no further tax on the dividends received. And for resident shareholders, the non-corporate shareholders pay tax at the rate of 10% on dividends in excess of 10 lakhs Indian rupees. The corporate resident shareholders are again exempt on this dividend income. And for computing DDT incidence or the distribution tax incidence for the distributing company, if the distributing company receives dividends from its subsidiary, which is defined to mean an entity in which the parent holds more than 50% stake, then these dividends which are received from a subsidiary company are not subject to DDT again. So that's the exemption which is there under current law, which ensures that there's no double incidence of DDT if the dividend is received from a subsidiary entity. The condition there was that dividend needed to be distributed in the same year as receipt of dividends from the subsidiary. Now, going forward, from 1st of April 2020 onwards, this dividend taxation regime is changing. Until now, the tax incidence was on the company. Now the tax incidence is being shifted to the shareholder. So what will happen is companies will no longer be required to pay distribution tax. Shareholders will be subject to tax on the dividend income that they receive. If the shareholder is a non-resident of India, then the domestic tax law provides a tax rate of 20% on the dividends received by a non-resident shareholder. But here, the applicable tax treaty between India and the jurisdiction of the non-resident shareholder would also be relevant to basically assess if the treaty provides a more favorable rate compared to 20% and what are the conditions for claiming the lower rate under the treaty. So generally, there's a large number of tax treaties where the tax rate is around 15% or 10% under various tax treaties that India has signed. For resident shareholders, such dividend income will be taxable as ordinary income. So it could be subjected to the full tax rate of 30%, or for companies, depending on which regime they're falling in. What is important to note is that the law has allowed deduction for inter-corporate dividends, which means that if one company receives dividends from the other company and then distributes those dividends onwards to its shareholders, there'll not be double taxation of dividend flowing through the chain. And we will delve deeper into this by way of an illustration in the next slide. Another important point to note is that until now, there was no expense set off which a company could have claimed against dividend income, because dividend income was exempt in the hands of the recipient. But now, if the company has, let's say, borrowed debt to make underlying investments, then it will be able to claim a set off of interest, provided this will be capped at 20% of the dividends that it distributes. Now, explaining this further by way of an illustration, let's look at this multi-tiered corporate structure where the underlying subsidiary is a foreign company, FCO, which is outside India. It is owned by an Indian company, Company A, which is further owned by Company B, and Company B has shareholders on the top. Now, under the current law, as well as the new regime, so there is no change with respect to dividends received from a foreign company. So the provision there is that if a foreign company declares dividends to an Indian resident, and if Indian resident owns more than or equal to 26% stake in the foreign company, then such dividends are taxable at the rate of 15% plus surcharge and cess. So let's say in this example, FCO distributes $100 as dividends to Company A, and Company A owns more than 26% stake in FCO. So what will happen? This $100 will be subject to tax in the hands of Company A at the rate of 15%. When Company A distributes the same amount of dividends to Company B, then there is no set-off or deduction available to Company A, and it becomes a taxable income for Company B. Let's say company distributes $80 to its shareholders. In that case, what will happen is Company B will be able to claim a deduction to the extent of amount that it distributes, which is $80. So for computing Company B's income, $100 is what it has received, and it has declared $80 as dividend, so that will be deductible. So effectively, $20 will be the net taxable income of Company B as far as its dividend income is concerned. The only condition that Company B needs to satisfy to be able to claim this deduction is that it has to distribute dividends to its shareholders by the due date of return filing for the relevant year. So let's say this dividend, Company B receives dividend from Company A in the year 2021. It will have to ensure that it distributes the dividends to its shareholders by the due date of return filing for the year 2021. Now, when the shareholders receive $80 from Company B, they will pay tax at $80 based on the applicable tax rate which apply to those respective shareholders. So here, what is the overall effect? The overall effect is that with respect to dividends received from foreign company, no one gets a deduction in the whole corporate structure chain, and Company A is paying full tax on the $100 that it is receiving, or 15% tax based on the shareholding in the foreign company. But the dividend that is declared by the domestic entities, which is Company A and Company B in the structure, the $100 is not getting taxed at each stage, but that gets split. So Company B pays tax on $20 and shareholders are paying tax on $80. So this basically ensures that the same dividend is not taxed at each stage of a corporate structure. Another important point to note is that for receipt from foreign companies, there is no deduction. So to that extent, that will still there will still be some sort of double taxation as far as the dividends received from a foreign entity is concerned. So let's look at another scenario, LLP versus company scenario. Now, of course, no structuring discussion is complete without making this comparison as to whether the business vehicle in India should be a limited liability partnership or should it be a corporate vehicle. Until now, this analysis or the conclusion was simpler because the corporate tax rate and the tax rate applying to an LLP were same, which is maximum effective tax rate of 35%. Plus companies were paying distribution tax of 20%. So that naturally made LLP a more attractive vehicle, because let's see in this example where LLP is subject to tax rate of 35% and no change has been proposed in the taxes applicable to an LLP. So LLPs will continue to pay tax at 35%. When LLPs distribute a share of profits to their partners, there is no further tax, neither in the hands of the LLP nor in the hands of the partners. And that is going to remain so even in the new regime. Now let's compare it to a corporate structure under the new regime. Now in this structure, we have taken a few examples to show how the taxation consideration or the structuring consideration will change depending on the residential status of the shareholders. Now here, let's assume for simplicity that the company declaring dividends is falling under the 25% tax regime. When it declares dividends, let's say to a US shareholder, then Like we discussed, under domestic law, there is a 20% withholding tax rate on the dividend distribution. But looking at the India-US tax treaty, the dividend withholding tax rate is capped at 15%. And that is subject to the stake held by the US shareholder. So in the treaty, it says that if a US resident holds more than 10% stake in an Indian company, then the withholding tax rate on dividends will be capped at 15%. Let's say the shareholder is a Singapore resident or a resident of China. In that case, these treaties have a more favorable rate of 10% applying to dividends received from Indian companies. Some other jurisdictions like France, certain other European countries, and Mauritius, treaties that India has with these jurisdictions have a low tax rate of 5% applying to dividend income. And if we have Indian shareholders as the shareholders of an Indian company, then since there's no treaty applying, etc., and dividend is taxed at ordinary rates, there'll be a full tax rate applicable to the dividend income received by an Indian shareholder. So here, depending on where what is the jurisdiction of the shareholder, it will really determine whether a corporate structure works better from a tax perspective or an LLP structure works better from a tax perspective.
Thank you, Ritu, for taking us through the corporate tax in India and explaining us how dividend income will be taxed after 1st April 2020. You explained that the dividend income taxation has changed. So, and new manufacturing companies will be eligible for 15% tax rate. So, will this 15% tax rate apply blanketly, or is this applicable only on certain specified incomes of new manufacturing companies?
Sure. So in case of manufacturing companies which are falling under the 15% regime, in case of income which is not linked to manufacturing, so which will be the dividend income, the law says that the dividend income will be subject to tax at 22% and not 15%. So this is something which is to keep in mind, is that for manufacturing companies, business income is taxable at 15%, but other income like dividends or income from other sources, that will be taxable at the rate of 22%, which after adding surcharge and cess results in a maximum effective tax rate of about 25%. And also the interest expense that we discussed, which is capped at 20% of the amount of dividends, manufacturing companies will not get that set off. So that's another differentiating point for manufacturing companies. And I think the idea of the government has been that since the tax rate itself is as low as 15%, these other incentives have not been allowed to a manufacturing company.
I believe our participants would have already started evaluating the impact of this new regime on their businesses. I mean, given that the allowability of interest expenditure, our participants would be, I think, evaluating and assessing the options for debt funding in equity acquisitions also now. To take it forward, I would like to invite Vinita to explain us and give an analysis of the impact of this new regime on different stakeholders, such as existing companies, new manufacturing companies, and existing companies which are planning to set up new manufacturing units in India. Vinita.
Thank you, Raghav. So coming on to the existing companies, as Ritu has mentioned, that historically the regime was the company was required to pay tax at a base rate of 30%, but now they have an option to look at what are the other rates available, whether base rate of 22 or base rate of 15, depending on the activity they are engaged in. So for an existing company, if they are a company which is already paying a tax at 30%, they can opt to go for a 22% regime, depending on certain conditions. Now, what are those conditions? The first thing is, if you take the 22% regime, then the minimum alternate tax, the provision which Ritu had explained, would not be applicable to them. The second condition is they have to forego certain deductions. To give you an example, if an entity is eligible to claim an investment linked incentive, essentially those incentives are, if you incur a capital expenditure, in the normal course, you get a depreciation which is spread over a period of years. Whereas if you get an investment linked incentives, then you get an 100% deduction of the capital expenditure. Basically, it results in a timing difference. So if an entity wants to take a 22% regime, they would need to forego such tax incentives. The second thing which they would need to forego is additional depreciation. To give you an example, if a company A has bought a plant and machinery for rupees 100, in the normal course, the general depreciation rate is 15%, and over and above the 15% depreciation, in the first year, they are also entitled to get additional 20%. So overall, they get around 35% as a depreciation rate in the first year. Whereas if you take a 22% regime, instead of 35%, you get only 15% as a depreciation. Again, it just results in a timing difference. The depreciation would take a longer period as against a shorter period. But the catch is not only for going forward, you would need to forgo, but even in the past, if you had paid a MAT tax, then under the income tax provisions, you get a credit of the MAT tax paid, which is called as a MAT credit. Essentially, MAT credit can be offset against your future tax liability subject to certain conditions. So if you want to take the 22% rate, you would need to forgo if you have any balance MAT credits available to you. So that results in a sunk cost for the company. Then you move on to see if you have any tax losses with the company. Tax losses such as business loss or depreciation loss can be continued going forward even if you take the 22% regime. But if you have any loss which is because of an incentive which you claimed or because of an additional depreciation to the extent of the loss component which relates to these two buckets, you would need to forgo. Therefore, you would need to do an analysis if you're an existing company, whether you should directly jump to 22% or whether you should exhaust your available incentives, available losses or MAT credit, and then arrive at this decision. So there is no direct solution. One would need to keep in mind the overall number exercise and then arrive at a conclusion. Because it's also very important to note that once you opt for this deduction, you cannot opt out. Whereas there is no bar, like you can opt in any time during the course. If you are an entity, you can opt for 22%. Then the next change is for new companies. If I'm setting up a new company this year, or whether the new company, what are the available options? Either they can go for the base rate of 30%, which comes with the option of claiming the incentives which are there, with the option of getting additional depreciation, or the new companies can be governed by the 22% rate, which I just explained, or the 15%, which I would explain in the subsequent slide. So for a new company or an existing company, if they want to take a 22%, it is a sector agnostic. Whether you are into a manufacturing sector or a service sector or a construction industry or pharma sector, it doesn't matter. You can take the 22%. But if the new company is engaged in manufacturing and they want 15%, then they have to be only engaged in manufacturing sector. So for the new company, while primarily the conditions remains the same, if they want to take the 22% rate, they need to forgo certain deductions. But one thing which is good for them is at least they don't need to worry about any lapse of past MAT credit or past tax losses relating to additional depreciation or additional incentive. So does it mean that any new company should straight away follow 22%? Again, perhaps the answer depends on what the company is engaged into, whether it is engaged into manufacturing sector, whether it is engaged into a capital intensive sector, whereby if they get an incentive which is investment linked, they are able to get a loss which is for an indefinite period. One would need to do an assessment overall and then take a call whether I should take for 22%, 15%, or the historical 30%. The most important change is the manufacturing sector. As Ritu had said, for a manufacturing sector to boost the Make India campaign, now you can see the rates have been slashed almost by half. So normally the tax rate is 30. For a manufacturing entity, it is as low as 15%. Now it is applicable to whom? It is applicable to an Indian company, and there is also a period by which the Indian company should have been set up or formed. It should be after 1st October 2019. And also there is a gestation period whereby you would need to ensure that the production or the manufacturing activity has been commenced before March 2023. So say if a foreign investor wants to set up an LLP or a branch in India, then definitely for the LLP or the branch, they would not be entitled to the 15% regime. They would need to look for a subsidiary option to explore the 15% regime or the 22% regime. The next thing is, it is applicable to what kind of activity. The company should be engaged only in manufacturing activity or production. What is manufacture and what is production is not specifically defined, whereas there is a negative list whereby they say that if you are printing any prints or engaged in a publishing business, or you are converting gas into cylinders, it would not amount to manufacture. And also if you are a software developer, it would not amount to manufacture. And there was a in the recent budget, there was a amendment made or proposed to be made whereby even an infrastructure sector which is engaged in power generation would amount to manufacture. So whether your business amounts to manufacture or not, one would need to factor the definition around, and also there is a list which is going to be notified by the government, which will be in the negative list. So if you are a company which is getting your goods manufactured by someone else, say company A outsources its manufacturing activity to company B. Now, so in loose terms, company B is a contract manufacturer. So for company B, if it is engaged in manufacturing activity, it may be entitled to claim the 15% regime. Whereas company A, if entirely it outsources, it is not involved in supervision, it is not involved in manufacturing activity, maybe it may not be entitled. Therefore, even in terms of your existing manufacturing processes, whether you would be entitled if you go for an expansion, one would need to factor into these finer aspects while arriving at a decision. Say you are an automobile entity and you would be engaged in assembling of products from various parties. It may perhaps qualify, provided you can say assembly is resulting into a totally new product. A new product is transformed and there is an extent of activity also done by the person who's doing the assembly. Then they may be entitled to the manufacturing activity. So therefore, the key takeaway is one has to assess the business activities and see whether they can opt for the 15% regime. There are other conditions apart from the core condition that you are a manufacturing entity. The one of the other main condition is the business should not be formed by splitting up or reconstruction of a business already in existence. Now, what technically it means, the government, it's an anti-abuse condition. The government wants to ensure that actually a new manufacturer is entitled to this. They want to boost employment. So to one has to see whether you are just starting an activity by splitting up of business which is already there. To give you an example, company A has an up and running manufacturing activity of electric bulbs, and it is catering to, say, the southern market, part of India. Now they want to expand their production to other territories of India. They have an option to start in the same company, or they may want to start another company. Now, if they do in the same company, they would not be entitled to the 15% regime. But if you opt for the setting up a new company, they will be entitled. So to ensure that the new company is entitled, one would need to ensure that the new company is having a necessary wherewithal, infrastructure, whereby it is having it is investing in the plant and machinery. So perhaps the new company then should be entitled, because there is a demand driven need whereby they are looking for expansion. So that's how one would need to look into a finer aspects, how we are entitled or not. The second important condition is the manufacturing activity should be out of a machinery which is new. A second-hand machinery up to 20% is allowed, and if it is a machinery which is used abroad, there also there is a leeway. So again, one would need to invest in a new machinery so that there is a real manufacturing activity which is new, which is being carried out. And the third condition is the entity should not be engaged into non-manufacturing activity. or there is a leeway that you can be engaged into research and distribution of the products which you are going to manufacture. To that extent, there is an activity which is permitted. And what happens if you take these things? You would not be allowed any incentives which are otherwise available, say an SEZ which was available till last year, or an investment linked incentives which I had just discussed, or the additional depreciation. So one would need to factor these conditions, and in case of a genuine case where you are unable to meet the condition related to used plant and machinery, or activity of solely manufacturing activity, then it's a very welcome provision where we have seen that they have said you can approach the Central Board of Direct Taxes, which is the apex regulating body for the procedural aspects. You can approach them to give a specific exemption on a case-to-case basis. So one would see how the authorities have really made it a very welcome move if someone have a real genuine issue in meeting the condition. Of course, there is a catch that the door to approach the CBDT is not available if you are not in a position to meet the key condition of whether you're formed by a splitting of a business already in existence. So what is the impact of the manufacturing entity? The first impact is the business income from manufacturing activities is taxed as a concessional rate of 15%. When you have a non-manufacturing income like Ritu discussed dividend, there is a specific tax treatment for that. And if you say have an interest income, you have deployed your manufacturing surplus in fixed deposits. If it is incidental to manufacturing activity, it can be governed by the concessional rate. But if it is not incidental, then it would be taxed at 22% on a gross basis. Now you have a land on which the factory of your manufacturing plant is located. When you sell the land, if the land has been held for more than 3 years, then the tax rate will be as per the normal long-term rates, which is 20%. But if you have held it for less than 3 years, then in the normal course, you would have paid 30%. But in a manufacturing setup, if you opt for 15%, you would need to pay only 22%. And so there is, if you have a short-term asset like a plant and machinery on which you have claimed a depreciation, there is a lack of clarity whether you would need to pay tax at the rate of 22% or 15 or 30. So one would need to evaluate, and especially this would be very relevant also if a company is doing a slump sale of its business, then what should be the rate? If it is a long term, then the tax rate would be 20%. So that's how the impact of taxable income, if you take the 15% regime, pans out to be.
It has indeed been a very thought-provoking. Thank you so much, Ritu and Vinita, for a very interesting and enriching session. Before we proceed further, just a housekeeping announcement. If you have any questions, please use the Q&A panel on the webinar portal. We'll be moving to the Q&A session very shortly. I found a comparison of the different corporate tax rates in India of particular relevance, because what it shows that structuring opportunities are still available, be it existing companies, new companies, or new manufacturing companies. What it also shows is that there is no one size fits all approach when evaluating whether to opt for the new scheme. I mean, for all the CFOs and tax heads who joined us today, it means that if they want their companies to opt for this new concessional scheme, they will have to undertake a number crunching exercise and a critical assessment of their merits and the facts of their case. What is also very clear is that with the change in the mechanism for taxation of dividend income, the tax treaty analysis becomes extremely critical to attain tax efficient repatriation of profits to shareholders. Only time will tell whether this means a flight of capital from India or replowing back of profits into India for further investment. I believe our participants have also taken note of the fact that with the revised mechanism, the revised tax regime, LLP structure may not always be tax efficient, given that the headline tax rate for corporates in India have been slashed significantly. And I think everyone will agree that it will be incomplete if people do not take care of the commercial substance and transfer pricing considerations which are applicable to their structure. We now move to the Q&A session. This is your opportunity to raise issues of importance to you with our tax experts. If you have any questions, you can still submit it online in the Q&A panel provided in the webinar portal. I believe our team has already received some questions, so we'll make a start with these questions. And if you have any questions, please use the Q&A panel in the webinar portal. So the first question that we've received, and I think Ritu, you may be best placed to take this question. You explained that the new manufacturing companies have a concessional tax rate regime of 15%. What happens if one violates the prescribed conditions for availing the 15% tax rate for manufacturing companies? What will be the consequences if some company breaches?
So in case a 15% manufacturing entity breaches the conditions which are laid down for manufacturing companies, then they will fall under the 22% regime, and the tax which will be applicable to such company will be 22% and not 15%.
The next question is, does the new regime have any impact on companies which are undergoing distress sale or companies enjoying SEZ benefits? Vinita, you may be better in answering this question since you explained the impact of the new scheme.
Sure, Raghav. So it's a very interesting question because that's been a burning and key pain point in most of the distress deal. And with the insolvency bankruptcy code being getting very active, we see a lot of our clients also having the same issue. So as Ritu had explained, the key thing for a distressed in a distressed deal is the borrower when he takes a benefit because the lender is taking a haircut. So the haircut becomes the waiver of the loan becomes a taxable income in the hands of the borrower. Now, whether it is a taxable income under normal provisions, we have seen there was a litigation, and recently the apex court had ruled laid out the principles that in certain cases such income should not be regarded as a taxable income for the normal tax provisions. But when it comes to the book profits approach, since the waiver of income, if it gets credited to your profit and loss account, it will have a direct impact on your minimum alternate tax. So even though in case of a distressed deals where the borrower is sitting on huge tax losses, but there was a huge match liability because of the book profit impact. So in terms of them, if they want to opt for 22%, MAT clearly would not apply, and there is a clear-cut savings for them. But one would need to see whether the savings in the MAT cost, which is happening due to the transition from 30% to 22%, will it be higher than the cost which they would need to forego, say the MAT credit which they have paid in the past, or any incentive related losses, or any incentives which they may be eligible in future. So one would need to make a holistic assessment and then take a call, but definitely 22% is a welcome move for a distressed sector.
Vinita, just a linked question to that. Is there a time limit within which our clients will need to opt in for the new scheme, or they can approach and they can opt for the new scheme whenever they wish for?
So absolutely a valid question, Raghav. So when a company wants to take a 22%, there is no time frame given in the act. You can use all your losses, you can exhaust your MAT credit and then transition to 22%. But there is one technical point when the company has to look into it. When it comes to an additional depreciation, if there are any losses related to additional depreciation, that gets lapsed when you move to 22%. But if you have opted for such transition in the financial year March 20, there is a provision whereby they say that whatever additional depreciation you may lose may be adjusted in the WDV. Again, it's yet to be notified. One would need to see the finer prints, but overall, they can transition in any year.
All right. All right. We have one more question, and this one is related to foreign investors. whenever our clients approach our corporate teams or us, the first question that a foreign investor has is what is the preferred choice of entity? What is the preferred mode of instrument? So what are the key considerations from income tax perspective which a foreign investor should look into in light of the new regime? Ritu, would you like to take a shot at this one?
Sure. So for a foreign investor, of course, the two larger buckets are choosing the right form of entity in India. For example, whether it should be a limited liability partnership or a company. And the second one will be the mode of investing in India. Should it be an equity investment, debt investment, or a hybrid of debt and equity, which is, let's say, a convertible debenture. Now, under the new regime, of course, LLP versus company comparison will need to be done depending on the jurisdiction of the non-resident investor. Like we discussed in our presentation, it really varies depending on which jurisdiction the investor is coming from. And regarding the choice of instrument, of course, debt still remains an attractive instrument to invest into India, which may not be available in an LLP structure, but which will be available in a corporate structure. So again, a mix of all these factors will determine whether one structure works better than the other.
We've received some more questions, and I think, Vinita, this is related to a topic which you touched upon in your presentation also. And I'll read out the question. A company intends setting up a wholly owned SPV, which will have a new capital structure for making fresh investments at a location to expand the present product line. Now, the query that we have received is whether such SPV being incorporated after the cutoff date of 1st October 2019 as a new manufacturing facility would be eligible for the 15% rate. I mean, is there a straightforward answer to these type of questions that you have been receiving from clients?
So there is no straightforward answer, but yes, there is a possibility that the new entity should be eligible for 15%. And the care has to be taken is the new entity, whether who is deciding the new entity's actions, who's putting the money. If the new entity has the wherewithal, has the infrastructure, then it should be eligible.
The next question is with respect to the dividend taxation mechanism. Ritu, you explained that post 1st April 2020, repatriation of profits to shareholders may be tax efficient depending on the residential status of the shareholder also. With this change in mechanism, does buyback route score high when compared to a dividend or tax efficient repatriation? I mean, is this something for which you have already started receiving questions, queries from your clients?
Right. So again, the way LLP and company structure is generally compared, when we look at modes of distributing surplus cash to shareholders, there is a natural comparison between, let's say, a buyback option and a dividend distribution option. Now, until now, dividends and buyback both used to trigger tax at the level of the distributing company, where distributing company was subject to tax at 20%. And then there was no further tax in the hands of, let's say, the non-resident shareholders when they receive buyback proceeds or dividends. But going forward, buyback tax continues to be a levy which is applicable to distributing company, but dividend tax incidence will be on the shareholder. So again, now there is, of course, a possibility of having a lower tax rate compared to 20%, which is applicable to a buyback, when we look at dividend taxation when non-resident investor comes from the jurisdictions that we discussed, and even other jurisdictions with which India has a tax treaty. Now, so for buyback and dividend, until now, treaty analysis was not relevant, and therefore substance in the structures, etc., was not required to be evaluated. But going forward, for dividend taxation, treaty reliance and treaty analysis would become more and more relevant, which of course brings us to the connected and a very important point, substance in structures, because Indian tax laws have anti-abuse rules now, which are quite comprehensive. And even the treaties globally are being amended by the OECD BEPS initiative, which is the multilateral instrument. So going forward, of course, now gone are the days where one could just set up an entity in an offshore jurisdiction to only claim tax incentives. But if the structure needs to check a lot many boxes to be able to satisfy the substance requirements and then claim the beneficial treaty rates. And the other important condition which is there in all the treaties when we look at dividend taxation is that the dividend recipient should be the beneficial owner of that income. So again, in SPV structures, this is something which is always picked up by the tax authorities, and questions are raised whether the entity earning income from India is indeed the beneficial owner of income, or is it just acting as a front and the ultimate shareholders are controlling the use of that income. So of course, questions like that will become relevant even for an income stream like dividend, which was not the case until now. In terms of tax arbitrage, of course, buyback versus dividends may become more tax efficient, subject to the treaty analysis, of course.
I must say, with what you have explained, it seems that all our templates for India entry and different structuring considerations, all those will need to be revamped and rehashed, keeping in light the revised tax rates for corporates in India. We have time for two more questions, and I think the first question it's related more at a policy level. I think, Vinita, you mentioned that for the 15% tax rate for new manufacturing companies, there is a condition that they have to be set up after a particular date, which is 1st October 2019. And there is also a condition that they should uh, commence manufacturing before a particular date, which is 31st March 2023. Do you think that only the condition could have been only linked to the date of manufacture? I mean, what was the need to have a date of incorporation also?
So again, the date of incorporation is linked with, I think, the timing of the announcements. When the announcements were made, it was mid part of the year. And they want to ensure that it is being given to the companies which are newly incorporated and not with an entity which is already there in the present. So it's mainly to boost new companies doing that. There is a date that it should be incorporated after October 19. Again, there is a usage of the word it should be set up. Now, in common terminology, a company is incorporated, it should be set up. Whether the business is set up or not also pays a weightage.
Okay. I think this is the last question that we'll take in this Q&A session. Uh, on services and software support industry, Ritu, do you see any impact because of the change in these tax rates?
Yes, of course. I think for the service industry, the 22% regime is an attractive regime to opt for. And like we discussed, for existing companies to move over to this regime, they need to evaluate if they have any past MAT credits, because those will lapse. So let's say computer or service companies operating out of a special economic zone, which had availed tax holiday for, let's say, past 10 years, then they were not paying tax under normal provisions, but they had MAT credit, and MAT credit must have been accumulated by now. MAT credit is available for set off for 15 years. So that evaluation one should do as to how much is the quantum of past credits, and if the shift is made now versus after exhausting the MAT credit, then what is the real advantage? But of course, for the service sector, the 22% regime is the regime to go for, which after adding surcharge and cess results in a 25% tax rate.
I think I'll have to take one more question, and I'll point this one at you, Vinita. You mentioned something about restructurings. Do you feel that because of this change in corporate tax regime in India, will there be any impact on business restructurings? I mean, do you see those going for a toss, or do you see more uptake in that sector?
Again, a very good question, because yes, I would see the change in business structuring. To start with, like bare minimum like questions which we received. If I want to start a new facility, it's also an inorganic growth or an organic growth. Where do I start? That's kind of restructuring. There can also be a restructuring whereby a company is already claiming 15%. They are going to be for synergies. There is a group consolidation happening. Then if it merges with company B, whether company B would be entitled to continue those deductions would be interesting to see, as there is a provision whereby they have given that company B, being the amalgamated company, should be eligible to get 15% provided conditions are met. Now, how do you read the fine print to say conditions are met? There can be various scenarios. Company B is already eligible since it has an upbuilt manufacturing facility already in place. Then perhaps the answer seems yes. But if it doesn't have and it inherits the manufacturing activity of company A, one would need to see how company B would fit into it. So therefore, the mode of restructuring going forward, whether it is a pure vanilla start of a new company or a consolidation by way of merger or a hive off by way of slum sale or demerger, whether there will be any impact on the tax rates, because it will have a direct impact on the projections when the investor looks at forming the same doing the same business in a new entity. One would need to factor those things, and one would need to see how the law evolves, because presently there are certain things, there are loose ends. It needs a closer monitoring and evaluation.
We are out of time now. Thank you so much for your questions. The questions which we have not been able to deal with today, we'll take all those questions offline by email. Now I'll request our webinar team to make open the live poll. For the participants, there'll be an option on their screen. You may select the most appropriate option at your convenience. We'll take the poll live for next 5 seconds more. Thank you so much. I hope you found this webinar interesting and a worthwhile investment of your time. We certainly enjoyed bringing it to you today. As I mentioned earlier, after the webinar, a copy of the presentation and a link to the video recording will be shared with you. If you have any questions, please do not hesitate to contact our speakers or me. Our contact details will be there on your screen at the end of the webinar. After the webinar, there will be a short survey requesting for your feedback on the webinar. Please take your time out to share your feedback on this webinar, be it comments, criticism, and even compliments. It will take less than a minute to complete. Once again, we thank you for participating in today's webinar, and we look forward to being of service again at future Khaitan webinars. Thank you.